Energy isn't about equilibrium, it's about tension. Today, crude oil sits around $60 per barrel. Natural gas hovers near $3 per MMBTU. And across America, communities built on extraction are recalibrating what prosperity means when prices collapse 23% from their January peak of 78.71. This isn't a blip. It's a reckoning shaped by OPEC plus flooding markets with 630,000 barrels per day in September alone, trade friction dampening Chinese demand, and American operators proving they can maintain record 13.6 million barrels per day production with 13% fewer rigs than a year ago. I'm Mark Roach, and this is FutureWise Energy, an innovative voice, an independent upstream energy platform supported by individuals, where I share my views developed across cultures, technology, operating oil and gas fields, executing M&A, as well as leadership and startups. I draw from a wide range of personal experiences from over 30 years in the industry. The price collapse stems from converging forces that would test any operator's resolve. OPEC Plus completed unwinding 2.2 million barrels per day in voluntary cuts, prioritizing market share over price support. Saudi Arabia, with significant spare capacity, appears willing to accept sub-$65 crude to pressure higher cost American shale producers. Meanwhile, the EIA, Energy Information Administration, projects Brent crude averaging $62 a barrel in the fourth quarter of 2025, dropping further to $52 in 2026 as global inventories swell. The International Energy Agency forecasts a surplus of 2.35 million barrels per day in 2025, widening to 4 million barrels a day in 2026, nearly 4% of global demand. Trade tensions between Washington and Beijing compound the pressure, creating demand uncertainty that reduces fuel consumption forecast. Natural gas, well, it offers some limited relief. Henry Hub recovered from summer lows below 290 per MMBTU to around 345 in October. But the EIA revised 2025 forecast down to 342 and 2026 to 394, citing higher than expected production and storage levels that keep prices below thresholds needed to incentivize significant new drilling. The Permian Basin accounts for nearly 50% of U.S. crude output at approximately 6.6 million barrels per day. Yet drilling rigs declined to 250 as of mid-October, down 53 from year-ago levels, a 17% contraction. ConocoPhillips announced plans to slash up to 25% of its global workforce, potentially eliminating 3,250 positions by year-end, following its $22.5 billion Marathon Oil acquisition. Halliburton reportedly cut between 20 and 40% of staff across 3 business divisions. These reductions come despite continued production growth, demonstrating how technological efficiency gains allow operators to maintain output with fewer workers and rigs. Yet local data reveals nuance beneath the headlines. Employment in Midland, Odessa grew 2.5% from Q1 to Q2 in 2025, outpacing state growth of 1.6% and national growth of 1.1%. Average hourly earnings jumped 9.9% year over year to $37.23 per hour, while unemployment held at 3%. Hotel occupancy rates are near capacity on weekends. Restaurant traffic remains strong, and businesses report year-over-year growth despite the drilling slowdown. Sarah Harris, the executive director of the Midland Development Corp, noted the region's favorable geology with multiple hydrocarbon-rich rock formations allowing drilling at different depths, continues providing competitive advantage even as prices soften. Forward-looking indicators suggest challenges are ahead. The Dallas Federal Reserve's quarterly survey found more than half of oil and gas executives reporting worsening business outlooks compared to a year ago, with about 41% of exploration and production companies experiencing theft-related disruptions and many planning capital expenditure reductions. West Texas communities are preparing through financial planning and efforts to diversify beyond oil and gas. North Dakota's Bakken region experienced aftershocks from Chevron's $53 billion Hess acquisition, with over 100 jobs cut across Minot and Tioga in September. Chevron notified Job Service North Dakota that 111 positions, 63 in Minot and 43 in Tioga, would be eliminated beginning September 26th, representing larger reductions than initially expected as the company works to integrate operations and reduce per barrel cost. Active rigs fell to 32 from 39 a year ago, an 18% decline. Ron Ness, president of the North Dakota Petroleum Council, characterized the move as part of a broader industry trend aimed at lowering cost as crude hovers around $65 per barrel, approximately 16% below the previous year's average. Despite job cuts, North Dakota maintains over 1,000 oil and gas job openings and unemployment near historic lows at 2.5%. Production remains relatively stable. Through first quarter 2025 saw just 1,164 new wells producing 2,492 miles of horizontal drilling, marking the lowest figures for both count and total footage since 2020. The cyclical and seasonally based nature of North Dakota oil development makes it difficult to retain skilled labor during downturns, creating workforce challenges when activity eventually rebounds. Communities like Williston, which invested heavily in infrastructure during the boom years, including a $70 million recreation center with an indoor water park, now faces challenges to maintain these facilities with reduced tax revenues. Oklahoma's oilfield communities experience hardship, primarily through oilfield service companies supporting drilling operations across multiple basins. Halliburton maintains significant operations in Duncan, though the company hasn't disclosed specific numbers for Oklahoma facilities following earlier layoffs of 240 employees from its Duncan Service Center in 2020 and an El Reno operation shut down following an earlier workforce reduction of 350 employees. Halliburton CEO Jeff Miller stated during quarterly conference call that the oilfield services market will be softer than previously expected over the short to medium term. ConocoPhillips' broader workforce reduction also affects Oklahoma operations, with the company reported exploring the sale of oil and gas assets inherited from its Marathon Oil acquisition. Bartlesville, where ConocoPhillips maintains a major employer presence, faces uncertainty as the company implements its 25% global workforce reduction. Wyoming's energy towns experienced gradual but persistent job losses as of June 2025. Wyoming's mining sector, which includes oil and gas, employed 8,300 workers, representing a decline of 500 jobs or 5.7% compared to the previous year. The Casper Metropolitan Statistical Area lost 200 jobs year over year through June. Active oil and gas rigs, those counts tell a similar story, with Wyoming operating just 9 oil rigs and 4 gas rigs in June, down from 12 total rigs the previous year. Oil production fell 3% year over year through April, while natural gas production declined about 0.4%. Despite mining sector struggles, Wyoming's overall economy shows resilience, with statewide unemployment holding steady at 3.2 to 3.3% through mid-2025, below the national average of 4.2% to 4.3%. Sweetwater County saw unemployment improve from 3.5 to 3.1% between July and August. Campbell County experienced unemployment decline from 2.9 to 2.5% over the same period. The state's diversified economy with significant coal, natural gas, and tourism sectors has helped buffer some communities from the full impact of lower oil prices. Louisiana's oil and gas contributes 25% of the state's economy and supports over 306,000 jobs, generating $25.5 billion in annual wages and adding $77.7 billion in value to Louisiana's economy. Any disruptions to this industry provides profoundly consequential for communities along the refining corridor from Baton Rouge to New Orleans. Phillips 66 announced plans to lay off most workers in its Los Angeles refinery in December, and as the facility prepares for closure affecting approximately 600 employees and 300 contractors. While this California closure doesn't directly impact Louisiana, it signals broader industry trends affecting refining capacity nationwide. Valero Energy announced its plans to idle, restructure, or cease refining operations at its Benicia refinery in California by April 2026. The EIA expects U.S. refinery capacity to decline by 3% by the end of 2025, with multiple facility closures putting pressure on workers throughout the industry. Louisiana's refining corridor, home to 15 oil refineries processing 2.8 million barrels a day, represents 16% of the national refining capacity. It faces challenges from weakening refining margins despite contributing $1 billion in state and local taxes annually. A comprehensive 2025 economic impact study found Louisiana's energy sector employment highly concentrated in 4 super regions. The river corridor from Baton Rouge to New Orleans supports 134,654 energy jobs, generating $11.4 billion in earnings. The Bayou region from Lafayette to Houma accounts for 62,485 jobs with $4.7 billion in earnings. Southwest Louisiana supports 26,620 energy jobs with $2.3 billion in earnings, while Northwest Louisiana maintains 27,236 jobs generating $2.1 billion in earnings. Louisiana's energy industry has declined significantly as a share of the state economy. In 1999, oil and gas companies accounted for 33% of the state GDP. By 2022, that figure fell to just 14%. The industry's contribution to state revenue dropped from 40% in the late 90s to just 4.5% today. This structural decline left Louisiana ranked 49th amongst states in GDP growth and population growth, with economists warning that continued reliance on fossil fuels for economic revival is unrealistic. Communities in Louisiana's industrial corridor, particularly in predominantly black areas between Baton Rouge and New Orleans, known as Cancer Alley, bear environmental burdens from petrochemical facilities while receiving diminished economic benefits as automation reduces workforce needs. Alaska's North Slope sends an average of 465,000 barrels of crude oil south each day through the transatlantic pipeline system, facing longer-term structural challenges as production continues its decades-long decline from the 2 million barrel a day peak reached in the 1980s. While Alaska hasn't experienced acute job losses affecting lower 48 communities, state officials and residents worry about sustainability of an economy heavily dependent on oil revenues. The state government collected significant taxes and royalties on oil production that funded all government spending without broad-based income, sales, or property taxes during the height of the boom. Alaska established a wealth fund now valued at over $80 billion and began distributing dividends to every resident through the permanent fund. Declining production threatens this fiscal model. In south central Alaska, home to 63% of the state's population, including Anchorage, utility companies warn that they may lack sufficient natural gas from current sources to maintain uninterrupted power and heat. This energy shortage paradox exists despite Alaska holding the fourth largest proven reserves of oil and gas in the United States. The transatlantic pipeline is designed to carry oil, not natural gas, and state law prevents producers from flaring excess gas, requiring it to be reinjected into the ground. Alaska North Slope communities report unemployment rates around 5.2% as of March 2024, higher than the U.S. rate of 3.8%, with median household incomes ranging from $62,321 in Point Hope to $94,661 in Utikavik. Non-Hispanic white households receive median incomes more than $100,000 higher than those identified as American Indian and Alaskan Native, highlighting economic disparities. The employment picture across U.S. oil and gas communities reflects a troubling trend of sustained job losses even as production remains near record levels. Major oil companies announced thousands of job cuts through 2025, with ConocoPhillips leading up with 3,250 positions eliminated, 25% of its workforce, followed by Chevron's workforce reductions following its Hess acquisition, and ExxonMobil reportedly is considering cuts of 20 to 25% of its global workforce. Around 3,000 upstream workers lost jobs in June and July alone, according to the Texas Workforce Commission, as crude prices hovered around $63 a barrel. The number of people working in oil and gas extraction and related services dropped 3% through July compared to the previous year, according to the Bureau of Labor Statistics. The U.S. oil rig count stood at 418 as of mid-October, down 63 rigs or 13% from the previous year. This represents the lowest rig count in years, yet weekly U.S. crude production hit record levels of 13.6 million barrels per day. This paradox reflects a dramatic improvement in drilling efficiency, with operators extracting more oil from fewer wells through longer laterals, optimized well spacing, enhanced hydraulic fracturing, and designs. Ron Gusick, CEO of Liberty Energy, remarked that the level of activity has dropped to a point where sustaining current production will be very challenging, highlighting concerns that today's reduced drilling will eventually lead to production declines. Most U.S. oil firms need prices above $80 a barrel to sustain current levels of dividends and share buybacks, creating pressure for further cost reductions if prices remain depressed. Bank of America analysts warn that crude prices could fall below $50 a barrel, while EIA's projection of 52 Brent in 2026 would make many U.S. shale operations unprofitable. Ben Shepard, president of the Permian Basin Petroleum Association, noted that tariffs lead to an economic turndown. It could also affect demand and deal a blow to the industry. Communities facing oil price hardship pursue various strategies to adapt. In the Permian Basin, regional leaders emphasize financial preparation, being aware that revenues may decrease in the next few years, and then growing appetite for industry diversification, according to Sarah Harris of the Midland Development. The region hopes to create a logistic hub around 2 new interstate highways Congress designated through Midland, while attracting aerospace, defense, and data center companies drawn by surplus natural gas for power generation. Oklahoma and North Dakota communities with experience weathering boom-bust cycles emphasize workforce retraining programs and economic diversification initiatives. However, the scale of energy sector employment, particularly in smaller communities where oil and gas represents the primary economic engine, makes rapid diversification challenging. Louisiana faces particularly difficult choices, with energy contributing to a quarter of the state's GDP, but providing diminishing state revenue and fewer jobs due to automation. Economists recommend something akin to a federal military base closure committee to help communities transition. Economist Lauren C. Scott noted that everyone wants to grow and everyone wants to do better, but finding that next sector that can grow big time, well, that remains challenging. Alaska's challenges require long-term solutions given the state's geographic isolation and climate constraints. The proposed Alaska LNG project to move North Slope gas to Tidewater with offtake points for in-state customers represents one potential avenue for economic development, though timeline and financing of that remain uncertain. As of October 23, 2025, U.S. oil and gas communities in Texas to North Dakota, Oklahoma to Louisiana, Wyoming to Alaska report varying degrees of economic hardship, as crude languishes around $60 per barrel. The hardship reflects a confluence of factors: OPEC plus, production increases, flooding global markets, trade tensions dampening demand, remarkable efficiency gains allowing production to continue with fewer workers and rigs, and structural shifts in the global energy transition. With major forecasters predicting sustained oversupply through 2026 and prices potentially falling below $50 per barrel, communities dependent on oil and gas revenues face prolonged uncertainty. Yet the story isn't uniformly bleak. Production remains near record highs. Some regional economies show resilience. Natural gas demand continues growing to support power generation and LNG exports. Communities that successfully diversify their economies and maintain fiscal discipline during downturns may just emerge stronger when prices eventually recover. The fundamental question facing these communities is whether current conditions represent another cyclical downturn in an industry known for volatility, or whether structural changes in global energy markets presage a long-term transformation requiring more dramatic economic adaptation. The answer will likely vary by region, with some communities successfully weathering the storm while others face more fundamental challenges to their economic models built on the shale boom or over the past decade. The rig count doesn't lie, but it doesn't tell the whole story. 418 rigs producing 13.6 million barrels per day proves American ingenuity adapts faster than markets price in. But physics, geology, eventually reasserts itself. You can't drill fewer wells indefinitely and expect production growth. At $60 crude, the calculus shifts from expansion to preservation, from growth to endurance. The operators with the strongest balance sheets, the most efficient operations, and the discipline to resist short-term pressures will define the next cycle. The communities that recognize this transition early and act decisively on diversification won't just survive the current downturn. They'll position themselves for opportunities that emerge when the market inevitably swings back. I'm Mark Roach, and this is Future Wise Energy. Keep your wits about you, your eyes wide open. Be ready to improvise.